Joining me now is Mark Storey, Head of Economics at DairyNZ. We're going to look at the impacts of recent global events and resulting disruption, which have caused various cost pressures to farming businesses, a huge issue for dairy farmers here in New Zealand. We continue to operate in an uncertain environment, Mark, so I'm really keen to unpick this a wee bit further. My name is Rowena Duncum, by the way, from the Country Radio Show, and as I say, with me is Mark Storey, Head of Economics at DairyNZ. Now, recent global events, including a pandemic, you had to be hiding under a rock in the back paddock to not know that has been happening. There's been conflict between Russia and the Ukraine, heat waves as well, we forget that's a thing. There's also been spiralling inflation, which in many countries has caused significant disruption right around the world. Global dairy markets, they've fared relatively well, I think it's safe to say, throughout the events. However, while shocks caused by the global pandemic finally start to recede, challenges of the economic reset remain. So, Mark, what effects have global events had on the New Zealand dairy sector?
Thanks, Rowena. Well, dairy is an export-oriented sector, so 95% of our production is exported. So anything that's happening on the global market is obviously going to have major impacts on our sector. In the last couple of years, the two major disruptions have been the COVID pandemic and the war between Russia and Ukraine. As you said, for the pandemic, the dairy sector actually pulled through that pretty well. There was a decline in prices, in global dairy prices in 2020, and that bounced back in 2021. And there were some disruptions to supply chains which had an impact on supply and demand on supply, but that's also largely corrected itself in 2021. But that said, we're not out of the woods yet. We are sort of seeing even now in the last couple of months some quite significant downturn in global shipping freight because of reduced demand. So it'll be interesting sometime yet before things settle back to any sort of pre-COVID normal. And the conflict between Russia and the Ukraine, the major impacts there have been the impact on energy prices and not to neglect cereals.
Yeah.
And the impact on energy prices is obviously flowing through into fertiliser prices as well, which is all having flow-through effects onto the New Zealand dairy sector.
It really has been the perfect storm,
Yep.
hasn't it? And as you say, a lot of factors at play that we didn't ever anticipate getting to this level.
Yeah.
Yeah, it's interesting. Look, are there any relationships that can be drawn to explain some of the effects we're seeing?
Yeah, we've tried to look back a little bit at this relationship between energy prices and milk prices, just not to get too caught up in the moment, but to sort of see what some of the historical patterns are. And we expect to see a relationship between energy and fertiliser prices. Fertiliser is an energy-intensive process, so when the price of energy or oil or gas goes up, by and large fertiliser costs will go up as well, and that's exactly what we've seen. And because of the conflict in Ukraine, we generally expect that those energy prices, unfortunately, are going to remain high for some time to come. The picture between global dairy prices and energy prices isn't quite as clear. If you look back over the last 10 years, they have tended to track each other quite closely, but sometimes that relationship's more coincidental than causal. So we're not so sure, it's not a given that if energy prices stay high, that dairy prices will stay high. We might see a scenario where the worst case scenario would be if those prices stay high and the milk price were to soften.
So that's the worst case scenario. Best case scenario?
Best case scenario would be the input prices drop down and the milk price stays high. That's not the sort of scenario we're looking at in the next couple of years.
Yeah. Look, based on the effects of these global events, what's the financial outlook for farmers right now?
It's mixed. Obviously, what matters most to farmers is the ratio between the input costs and the price they're getting for their milk on the farm. If dairy prices were to continue to track energy prices, then overall the outlook would be quite neutral. But if we do, as we are expecting, almost with some certainty that energy prices and other input costs will stay high in the next 12 to 18 months, wage costs, debt servicing costs, etc., then we're potentially looking at a scenario similar to what we had in 2012 where energy prices stayed high and milk prices softened. That's not saying that scenario will happen, but that is a scenario to prepare for. So overall, we're less confident that necessarily just because energy prices stay high, dairy prices will too. And we've also seen, similar to what happens with interest rates, there's a bit of a stickiness when these prices go up before they start to come down. So even though things might resolve themselves in Ukraine and in the oil and energy markets quite quickly, it would take some time potentially for those things to flow through into the commodity market prices.
Like, I guess, how we see the international price of oil go down and we expect our petrol pump prices to be dropped like immediately.
Yeah.
It doesn't always happen like that.
It tends not to be, and that's sort of the concern, that even though a point of turnaround may not be too far away, it might be some time before we start to see those price falls translate into the New Zealand economy.
Yeah.
I guess the other thing in all that as well is the decision by the Reserve Bank last week to hike the OCR.
Yeah, 75 basis points, unprecedented.
Yeah, quite aggressively, and there are more aggressive rates to come. So that's not a good news story for anyone, and it's not really, well, not for anyone, but for people who have debt, including farmers. And so that's obviously part of the scenarios going forward as well.
Yeah. Look, from a debt perspective, is the average New Zealand dairy farmer in a better position to deal with a scenario of declining milk prices combined with high input that you were just speaking about, also lending costs, than they were, for example, maybe back in 2015?
Yeah, this is actually a pretty good news story. The dairy sector is it's considerably better position than it was 5 to 7 years ago. Overall,
so silver lining.
Yeah, silver lining, and perhaps from some of those guidelines from the pressures from the banks, etc., to be bringing down, paying off principal, etc., in the last few years, has undoubtedly, that's come at a cost. But the sector is probably, in the current scenario, somewhat better for it. And then compared to other sectors, the dairy sector is looking pretty good as well. So the dairy sector, we're looking back to 2015, has paid back about 4.4 billion in debt.
Wow.
Whereas sheep and beef has gone up 2.26 billion. Horticulture have borrowed an extra 3.94 billion compared to that period, and other agriculture. So comparatively, the dairy sector is in a considerably better place than where it was. Two caveats to that story, though, are of course that while the overall level of debt's gone down, the rate of debt servicing, i.e. the interest rates, are going to be considerably higher than what we saw back in 2015. So you may have less debt, but you're going to be paying more for it. And the average figure shouldn't disguise the fact that there will be some individual farmers out there who are highly leveraged, who are quite exposed to increasing interest rates. So we can't lose sight of that fact either.
Yeah, especially people who have gotten into the industry recently and had to lock in at those higher rates than what we have seen in the last couple of years. Yeah, it must be pretty challenging. Look, what can farmers do practically to manage some of these cost pressures?
Yeah, we're saying number one is sort of plan proactively and be prepared for what might be on the horizon. So under any pressure where we're facing a potential squeeze in profitability, it's important to look at your costs of your inputs. What can be done somewhat differently? So we're encouraging farmers to regularly set and review their budgets and determine their costs, and be having that discussion with their farm advisors and salespeople, and trying to trim costs as much as possible. When costs do increase quickly, as we're seeing with interest rate costs, it's more challenging for farmers to stay on top of their budgets. And obviously milk price scenarios change as well. So we continue to advise farmers to be planning and looking ahead with a sort of a more optimistic scenario of maybe a milk price around at or above $9, and then a less optimistic scenario, which is more the 10-year historical average of $7 per kilogram milk solids. And if farmers are doing that, sort of preparing for a reasonably good outcome and a more pessimistic outcome, then at least they have some measures in place to address that. And that's all good sense, but in the current environment, it's perhaps more important than it has been for some time.
Yeah, absolutely. And I guess another key thing is just having that open communication with your bank.
Yeah, exactly. And your farm advisors, and just thinking about, is now the time this season to be doing some things a bit differently than perhaps has been done in previous seasons.
Yeah, exactly. Look, Mark Storey, Head of Economics at DairyNZ, it's a fascinating time to be Head of Economics at DairyNZ. A lot going on. But hey, thanks so much for your insights today because, yeah, as you say, things are changing so quickly at the moment. It's good to have an update on where things are at and what farmers can do to try and make things easier so they can be sustainable and stay in this industry as long as possible.
Thank you, Rowena. It's been a pleasure.
Cheers.
See ya.